is Elton Kane for Finextra at Cybos, and I'm here with Benoit Desserre at Societe Generale. Benoit, could you tell me a little bit about how the role of the corporate treasurer is evolving?
Well, the role of the corporate treasurer, essentially at what we're seeing today is what I could call a back to basics. We've had, for the past few years, a lot of regulations that happen in the market. I'm specifically talking about SEPA, but I'm also talking about FATCA, for example, and it's true that a lot of their timing was derived into making sure that their system was compliant with all the regulations that were coming out. Now, it doesn't mean that regulation goes away. It's just as maybe a little bit less important, and what we are seeing today is a bit of a back to basics treasury work, and that would probably go around three different angles. The first one is, how do I get, again, a better working capital management? You know, my assets, am I using my assets properly? Am I getting my liabilities to the level that I want? That's probably the first questions that we're getting back again very often. The second one is security and handling and safety of operations is again what they're looking at. And that takes different angles. We see demands that goes from basically what is the systems you're offering and can you offer me the very reliable tool that I'm looking for. It used to be a time when pricing, and I'm here mainly talking about Europe for that matter, when pricing was the key factor in deciding, okay, I'm going to go with one bank or the other. With SEPA, pricing went down dramatically to the point where I think today customers, treasurers are much more interested in what reliability do I provide with my systems? What investments are you making so that I'm confident that going forward you will be the reliable bank that I want to deal with? That's probably the second one. And the third one remains basically what we already had in the past, that's security. What security can I get from all your tools and systems to make sure that I'm complying with both regulations, to my internal standards, and of course to the preservations of all the data. And in that instance, that's a little bit of all the tools that we're putting in place for the corporates.
So as that role's changing, are you seeing other demands in addition to this, or the demands changing from corporates to the banking providers?
Yeah, the demand is changing. You know, if I go back to the first questions we were asking, it used to be a time when factoring, let's take that example because I think it's a very good point of what's happening today. It used to be a time when factoring was essentially designed for the corporations that were having a little bit of difficulties to raise cash, you know, to go through the lending process. So they were putting their assets and giving factoring financing on the back of the assets they were providing to us. Now, if you look at it today, you will see that all the very large corporates of this world, and I'm talking the very large, are no longer considering that as a must be when I'm in trouble, but are really considering that as a way to monetize their assets in a much better way than they were doing before. So in other words, they're just completing the examples of everything they can put together to get either both different financing, but also, as I said, to get a better value out of their assets. So factoring, in that essence, has become more prominent and acceptable to the very large corporation, which is absolutely not true if you go back about 5 or 6 years ago.
With these changes in the priorities for the corporate treasuries and their demands on the banks, what do you think banks can do to successfully meet those needs?
Well, maybe one of the first things is to make sure that we have the tools, the energy, and more important, the commitment that the corporate wants. You know, in this changing time, the corporate absolutely want to be relying on these banks. And when I mean that, I mean both from a perspective, you know, will you be there with the needs that I want in 1, 2, 3 years' time, and possibly even more, by the way. But the second one is, okay, I'm trying to figure out how can I get my cash management handled in a much better way. What are the options that you're offering? An example that I also give quite often is factoring, payment factoring. If you look at today, the treasurer wants to find new ways to control the outsourcing of pretty much all he's got on his own treasury management. So he's going to come to us and says, okay, if I want a better handle, if I want a better security of what I'm doing, maybe I should take control of all the payments and all the incoming payments that I'm getting from both my subsidiaries and my head office, from my main factories to my maybe second tier factories. And that requires from the banks to come up with appropriate solutions, payment factory might be an appropriate solution, but payment factories, as with every product, there is maybe the first level, I should say, and there's the upper level. An example is for reconciliations. You want to make sure that within your payment factory, you do have virtual accounts. That will help you dramatically improve your reconciliation from a pure accounting perspective. That's not exactly cash management, but that's when cash management means accounting, means security, means efficiency for the customer.
Benoit, thanks very much for your time.
You're welcome. Thank you.
And thank you for watching.